Hey guys, just as we got everybody on here before we get this thing kicked off, no, this is just a little tidbit. No, our goal is just to kind of go through things with everybody, the TCs and or investors both, just to help out, help navigate the issues, just things that we see along the way, how we can all do better, be better at what we do. Because at the end of the day, the better we are, the quicker we can get things done, the faster everybody makes money, whether it's, the investor, the seller, the TCs, whoever it might be. That's our ultimate goal, is just to help everybody kind of coordinate and organize a bit. And then the fun part about this too is I wanted the girls who are helping navigate all this for me, as you have questions, I kind of like to take questions as we're talking along the way. It adds to just the conversation. Sometimes it leads down through rabbit trails, but today it's an open forum on Q&A.
And this one here as well. Oh yeah, these two are fantastic.
And so just want me to go ahead and get started?
Yeah, whenever.
All right.
As you want me to slide through those shows, just let me know and I'll go through them. Thanks, Gordon.
Hey, Bernie, I don't have the slides up.
You want them up?
Do I need to pull them up?
I'll do it.
You're doing it for me?
Yeah.
It'll show up? Can you tell I am really computer literate here, guys? When they say I am old school, and I always show people this little thing, I'm old school.
HP12C.
Damn right. It is awesome. And of course, that came right up. Anyway, so see if I can expand this out a little bit. Bear with me, guys, and we'll fire this puppy up. All right, let's get the show on the road. Let's have some fun. Let's go over everything in detail. So first off, I've got my two awesome escrow officers with me today. Monteil Bruce, who's headquartered out of San Antonio, who runs a lot of our Texas operations. She's also Miss Wholesale. Y'all don't laugh at me, but I call her my sick puppy because she loves curative work. And in our investor world, man, we have got a lot of curative stuff we have to go through and do on every transaction we see. And she loves to dig into it, whether it's liens or whether it's probate or whatever it might be. And the other gal up there is Andrea Langston, and she is headquartered out of Scottsdale, Arizona. And First Option Title, guys, is we're licensed in Texas and Arizona as a title operation. And Andrea also heads up OFN National Escrow, which handles all of our national closings along the way. So you might have a lot of questions for her too as we go through. She covers this stuff pretty well. And I will say one thing, even though I've been doing this for 30-something years, I have a lot of knowledge of our industry and of the creative finance, wholesale transactions, whatever it might be. There's still things to learn, even on my end of the equation as well as theirs. And we're always trying to make sure we're on the same page. But let's just kind of fire it up a little bit. And I'm just going to flip through the slide a little bit and go. So she's going to advance them for me. So, as we're starting to talk about financing, a lot of you guys work on subject to transactions. I really think the thing is to know what sub 2 is, which means, of course, we're just taking over the payments on behalf of the seller. We are not assuming the loan. No, to assume a loan means you have to go out and qualify for it at the bank, and then the original seller is released from liability. And I will tell you, in the assumption world out there, that happens very, very, very rarely. Sometimes with VA loans, but just not that often. It's hard to do. And it's funny that you walk out on the street, guys, for all of us who are on this program today, we understand what sub 2 means for the most part and how it works, et cetera. You go out and talk to the common person on the street and you tell them you're going to buy their house subject to, they're going to look at you with like deers in the headlight. They are going to have no clue what you're talking about. So you need just to make sure you can properly explain that to them as you're talking to them. And don't assume, so for you investors on here, forgive me, that the investor has properly explained to the seller what's going on. You know, Monteil and Andrea and I see so much stuff out there when we get phone calls from sellers, they're going, what are y'all doing? You know, they don't know. And so for us to be better at our business and to eliminate issues and problems along the way, making certain your seller understands the transaction is all important. And whether it's a subject to transaction or a mirror wrap, which is a wraparound mortgage that is identical to the underlying debt terms. And by the way, we do a mirror wrap, guys, if y'all don't know, if we want to incorporate a balloon vehicle into our transaction. So in other words, if the seller doesn't want to have their loan floating around for the next 28 years, let's say, we can do a mirror wrap, and we can make the promissory note on a mirror wrap, non-recourse to the investor, which is an important thing to think about, because if we're not asked to put a non-recourse clause in a note, we're not doing it out there as we're drafting and getting docs prepared. But the mirror wrap allows the seller to create a balloon vehicle for a 3-year payoff, 5-year, 10-year, 15-year, something less than that original time frame if they so choose. And so just, again, understanding what sub 2 is, what a mirror wrap is, from that persuasion is awesome. And I don't know how many of y'all do full wraparound mortgages with sellers instead of a subject to. So the investor is buying the house, and instead of buying it subject to the debt and maybe putting a second lien on the property, which they do occasionally, they can do a wraparound, wrapping around the entire underlying debt, where that seller may want to have different terms, interest rates, and payment amounts. And in this industry, as y'all may know, all these things are viable. And again, it's up to the investor, of course, to negotiate this and then to let us know, you know, as the TC, what it is they're intending to do. But you've got to understand that as well to make you better at those kind of items out there along the way. So I just think getting a good grasp of the creative finance world so you can have that explanation to your seller, just to ensure that they understand the deal, it makes the transactions go so much smoother out there along the way. Now, another thing that, at least when I'm teaching classes and whatnot, and I'm talking to the investors who are out negotiating these deals, no, there are certain things we want them to try to get on that first visit to the seller. That, of course, that is the most current mortgage statement and the note and deed of trust, as well as the insurance policy. So make that note. And if they did not get that, as you might be talking to that seller, try to get those documents so you can provide those to the closing agent, because it makes our life a lot easier to know exactly what it is we're either drafting documents for, and you and your investor should have those in your file so you know exactly what you're taking subject to. No, is it a 30-year fixed rate loan? Is it FHA, VA, conventional? What is it exactly? You know, does it have it? Is it adjustable rate loan? Is it something different? But getting that actual document is good. And so often your sellers don't have that. And guys, your seller can simply go online and request it from the lender, and they'll email the note and deed of trust to them pretty quickly. If they've misplaced their insurance policy, they'll email that to them as well. And it's just getting control of those documents helps the transaction go smoother. Just to point out on insurance for a moment, you want that existing insurance policy so you can have the loss payee clause that is proper for the mortgage company. That's what I'm looking for when I'm getting that. And I'm gonna jump ahead just a moment on insurance for you guys, because insurance is one of the most important things in this business. When a property is sold, the buyer, the buying entity, whoever that might be, should be listed as an insured on the existing policy. You're going to find it very rare that the existing insurance company will add the new buyer, investor, whoever it might be, onto the existing policy as an insured. So typically the investor is getting a new insurance policy. And so in that instance, what you want to make sure you do is list the seller and of course the buyer as the co-insureds or additional insured, because if you do not do that, when the insurance company, or excuse me, the mortgage company gets the policy, they will kick it out. And we want to avoid that because that's really one of the biggest red flags that shows up out there. So we want to prevent that if possible. And then of course we put the lender on there as the loss payee. Now I might jump forward here just a little bit also one more time, because no, I'll get back to that here in a minute. I'm talking about land trusts. So Monteil and Andrea, if I don't talk about land trust, please remind me, okay? I want to just make sure that that comes up. You know, when I think it should be used, why, and how to utilize it along the way. So anyway, learning how to properly present to your seller what's going on, explaining the transaction in that regard, understanding the deal, making the seller comfortable is so important because, again, as I said earlier, our sellers have no idea what you mean by a subject to transaction or even a wraparound. So our goal is to properly explain it to them so they understand it, and it makes your deals go so much smoother, you know, along the way. And Bernie, you can flip up the slides here. I'm kind of a slide or two ahead of us right now. The other thing I think is so important is don't make any promises to the seller. Sometimes I see investors in the marketplace who will tell a seller that they're going to do the loan will be paid off in 6 months, a year, 3 years, 5. They'll tell them something like this to entice them to do the deal. When our clients are buying houses, especially subject to the debt, we always tell them that the transaction will be paid off through attrition, meaning monthly payments, whenever it's paid off. Don't expect it other than through the full term of the loan. We don't want to set any false expectations. And sometimes I see a lot of investors doing that, unfortunately, still to this day. So we want to make sure that that doesn't happen. So either educate your investor, educate the seller in that regard. Another thing about talking to the sellers that I see a lot of investors do, and this comes from the sub-2 community, which a lot of you might be involved in, is they want to try and incorporate this thing called a performance deed. So I'm assuming a lot of you have heard of a performance deed along the way. And that is simply a deed that is pre-executed at the time of the purchase of the property so that if the buyer fails to perform in making their payments, the seller can simply record it and take the house back. And I'm going to tell you, like, for instance, here in Texas, we have statutes that kind of fly in the face of that. This is nothing new, guys. This goes back for me to the late 1980s, early 1990s. We were trying to do the same thing. And I will tell you, every single law firm I went to here in Dallas just said, absolutely not. You're trying to get around foreclosure laws. It's not a good thing. You don't want to wind up in a courtroom with that. And I want you to think about this. If you buy a house on October the 1st, and a year later you record a deed because of non-performance by the buyer, that's also dated the same year, October 1st. What do you think a title company is going to think about that when they see it? It's going to look really strange and weird and raise every kind of red flag you can. So just, if you're going to try to incorporate one of those in the transaction, make sure you have talked to a knowledgeable real estate attorney in the state where that transaction is coming down, and make sure there are no negative issues about that before you move forward with that in any form or fashion along the way. The last thing, just to review about talking to sellers here for a moment, is reinstatements. And one of the things, so often we investors, when we're buying a property, our sellers are behind in payments. I would tell you that 95% of our transactions that we deal with are just like that. And some mortgage companies get that out to you in a matter of a few days. Some might take 7 to 10 days to get it out. And if we're up against the wall on a foreclosure, we've got to get that document. So oftentimes, while I'm talking to a seller, and you as a TC can do the same thing, is hop on the phone with that seller, call the lender right then, or if they have an acceleration letter of some type, call that law firm and be on the phone with them to assist them in ordering that reinstatement. We all assume they know how to do this. Never assume they have a clue of this stuff, guys, because they don't have a clue. Help them do that. And instead of having that reinstatement going to the seller, try to have it directed to you so you can have control of that, because we as a closing entity need that reinstatement to know what's going to be the requirement out there. And finally, talking about, well, I'll get there in a moment. So I just popped up here on this slide about representation. Now, sometimes as a TC, and most of the time you're working with the investor, but also along the way, we could have an investor to investor transaction that we're handling. And so just let us know if you're representing the buyer, the seller, or both. We know that most oftentimes you represent the buyer, who's usually the investor buying the house, and your job is to put this deal together and get it going. But sometimes we see some of these anomalies out there, and just let us know. And then finally, let us know what your state requirements are. Now, I always, we all might be in a certain state. For instance, we're in Texas and Arizona. I've got those two pretty well handled. But if you're closing a deal in Hawaii or Washington State or Massachusetts or Wisconsin or wherever it might be, it is so important to take a moment and know what that state's requirements are. And I probably jumped ahead here again, which I have a habit of doing. But what are the rules and regulations there? And in fact, guys, I'm gonna kind of stop right there for a minute. I'm gonna pull back because I have that down here later on. We'll go through that as well. So let's go into a very important topic here for a minute, and this is going to be contracts and disclosures. So Monteil and Andrea, you often pipe up here on things that you see along the way in the contracts that come in. But I just kind of wanted to start off and talk about what is it that we should have in contracts for sale when our client is buying the property. And I don't even want to tell you how much I hate these 1 and 2 page contracts. Here in Texas, I always talk to a lot of investors. They'll tell me, well, I don't want to use a TREC, which is a Texas residential real estate contract form, which is standardized in Texas, because the seller won't understand it. That's the most common thing I get out there. And I always go back to them. I go, how in the world do you think they bought the house in the first place? They used the exact same contract, And so I just don't like those kind of arguments that are along the way. But you need to have a contract that really protects both parties. And so often investors want to make it so one-sided, it's nuts. And sometimes when they do these little short and abbreviated contracts, they forget to leave out things like specific performance or attorney fees in the event of a default or things like that along the way. So I always like to suggest the utilization of a state promulgated form if and when possible. Now, I know a lot of you guys, as I said, are in the sub-2 community. And if you're using the sub-2 contract that was done, oh my gosh, what's Bill's last name? Out of Colorado, who prepared the contract for PACE. But anyway, he actually did a pretty decent contract that can be used in most states, and it looks okay. But for instance, here in Texas, although it's a decent little contract, it's not the best thing. Here in Texas, as I said earlier, you have to know your state's requirements. But here in Texas, we have so many rules and regulations. You've got to understand that. And I'm going to come back and we're going to talk about that in a moment, the things here in Texas got to have because it is so important along the way. But when you get a contract from your client, read the contract, highlight what is in there, make notes so you know what needs to happen, dates, those kind of things, and help your closing agent understand those too. So it helps them navigate your transaction because every time we get a deal, things are different sometimes. I had a contract came in from San Antonio and I had to read the damn contract probably 6 times just to try to figure out what the heck he was saying. It was he might think it's easy because he created it, but it was so convoluted, it didn't make sense to me. So read it, make your notes so you're able to communicate that to your seller, to your client itself, as well as your closing agent. One of the things that's so important to make sure you get in your contract between you and your seller is a power of attorney. And many states have statutory POAs that you may want to utilize. For instance, here in Texas, we have a promulgated power of attorney and we utilize it, created it to be a limited POA, but it needs to make certain that it has that property listed on there because your title companies are going to want to see that that POA references the property specifically to be handled along out there. So determine if the state where you're doing the deal has a promulgated POA or not, and try to utilize that form and not something that just pulled off the internet or something that your investor did, because so often they did the same thing. They just said, oh, it's on the internet. I found it. We're going to use it. And oftentimes it doesn't work. So be smart there along the way. Making sure that the sales price has been calculated right is so important too. You know, oftentimes we'll see it's being bought sub two. There may be arrears on the property. Oftentimes the seller's getting a down payment. They're getting paid, you know, X amount of dollars at closing. Now you have a couple of options, and when you look at that, where you can make the contract sales price, and we need to know that sales price for our settlement statements. It's the balance of the loan, of course, plus the down payment. Now you can add the arrears into the sales price if you want to, and the seller pays their arrears. Okay, that's great, but the problem with that is you're inflating the basis of the property, and your buyer is going to be paying that amount of money at closing. I like to take the loan balance on a sub two plus the down payment, and I show the arrears as a closing cost. So why do I do that, guys? I do that because then your investor can write off that amount in the year that the property was purchased, as opposed to adding it to the basis of the property. So this little tidbits can help out along the way with your buyer and some tax issues out there. You know, we want to make certain that our contract and or our disclosures contain proper due on sale explanations of what that means. And once again, guys, our sellers have no clue what due on sale is. They have never read that in their entire life. They don't know what it is. And of course, they're going to wig out as soon as you see that. So understand that. And what I like to do when I'm talking to a seller is properly explain that very simply. And that is, guys, due on sale simply means that if you sold the house for cash, you're supposed to pay the house, your loan off. Kind of common sense, right? But over the years, our banks, because they're control freaks, they've added, no, if you lease the house for more than 3 years, it could be a violation. If you sell the house with an executory contract, that could be a contract for deed in Texas, an agreement for sale in Arizona, a land contract in other states, or whatever that might be along the way. And yeah, I'll go back and explain that tax benefit in just a second. It's there, and they're getting scared going, I can't pay my loan off. Of course you can't. So I always ask two simple questions. One, what does the mortgage company really want? And guys, the universal answer will be their money. And number two is, do you think the mortgage company really wants to own your property? No, they do not. And it gets them past that hurdle so you can have that conversation and move on. So make sure it has a viable due on sale explanation. And the other thing is ensuring they understand that they have continuing liability on that mortgage until that loan is paid off. Make sure you have reasonable time expectations to do this and get it all done at one time. And remember, for all we investors, and I'm an investor too, time is money. Now, one thing that we can do in our offices to help you guys out, whether you're in Texas or nationally, we have disclosure packages that we provide to you as a courtesy that you can utilize. And this is to ensure that all things have been disclosed properly out there. And as I will tell the TCs as well as the investors is, we're not your attorney. We simply provide these as a courtesy to the for the transaction, and they can be used. You can interline them, you can throw pieces out, keep them. We don't care. We just want to do our very best to make sure that you guys have enough information for good disclosure between your seller and your buyer. So Andrea and Monteil, have you guys got any contract issues that you've seen that come up or pop up along the way that might be important?
Yeah, I want to mention one just real quick because we see this a lot where the contract actually comes in and it says sales price TBD. I don't, and you can correct me if I'm wrong, Scott. In my opinion, I don't think it's a valid contract if the sales price is to be determined later. But it also creates problems for us. We can't even order title without a sales price because the title company, the underwriter needs to know what liability they're looking at. And if we have to go through the contract and calculate mortgage arrears and underlying balances and cash to the seller and everything, it creates work, but it also creates liability on our end. So just please kind of do the math and do the calculating before the contract is submitted instead of a TBD for the sales price.
Or do an amendment to the contract, right? So that
Yeah.
when you get the information in, because sometimes you don't have the information you need. You know, when you submit the contract initially, it gets signed, you don't have that mortgage statement, or the seller can't find a mortgage statement, whatever it might be. And you need that. And guys, I'm gonna make a note real quick. If you're dealing with a seller who is in active foreclosure and they give you a mortgage statement, that mortgage statement is not what is needed because it's a foreclosure mortgage statement. You may have to ask your seller to go back several months to find one that is a legitimate mortgage statement that lays out the balance at that time, interest rate, PI, TI payments, taxes, escrow. No, is there any PMI payments along the way or other fees associated with that mortgage statement? And look at those dollar amounts that are on there, and it's easy to bring it forward with the principal and interest, the mortgage payment, the full payment along with late charges to calculate what the amounts of arrears are at the date of closing. So it's going to be fairly easy to do. And if you have questions about that, we'll try to help you and steer you through those things as well a little bit. But just there's a difference between a foreclosure statement and an actual mortgage statement. And we try to provide an underlying lien disclosure notice to a buyer out there to ensure that everybody's on the same page as to what the name, address, and phone number of the lender, the loan amount, interest rate, principal and interest payment. And of course, our lenders are never going to give consent. And I want to point one thing out to y'all. Here in Texas, this is a mandatory requirement to provide the underlying lien disclosure notice in both Spanish and English. But another requirement is that the seller is supposed to send that notice to their mortgage company. And I don't know of any other company out there that provides a secondary page to that notice that we do for the Texas marketplace, where the parties are agreeing not to provide that to the lender, which is very, very important to protect the parties in these transactions. So again, there's all these little nuances we've got to learn, along the way. Any other contract things, guys, that y'all come across that you think might be important?
Yeah, on the wholesale ones that we've been seeing here lately, they want to make sure to retain the rights, like to be able to speak with us still once they sell that piece of paper, and just to make sure they really lay out. We had that one last week, Scott, where they didn't really lay out how they wanted that non-refundable to work, and it didn't really swing in their favor just because of the verbals that we received as the title company.
Right. You know, I have that down at actually the very end of my list, Monteil, but we'll talk about it for a minute. Let's take a minute to talk about assignments, because besides buying houses subject to the debt, we also do a lot of representation with the wholesalers out there who are assigning their contracts along the way. And the investors get, or the wholesalers in the middle get really upset when we tell them that we can no longer talk with them about the transaction because they've assigned the contract. Because when you assign a contract, you are assigning away all of your rights in that contract. And now this between the seller and the back end buyer. So unless the investor, the wholesaler in the middle, has reserved the rights to communicate with the title company and the back end buyer, reserve the rights to receive communication, reserve the right to review things, maybe reserve the right that if the deal doesn't close on a certain date, to get the assignment back, and it terminates automatically. And then they give direction to the title company and the closing agent how earnest money is to be handled without having to have both parties execute it, is so important. Because these investors, the wholesalers, they'll assign the contract and they call us and want information. It's like, guys, you're not part of the deal anymore. You've assigned the contract, and they go ballistic. And so we don't want that to happen. We want everybody to work together on it. But we see
That's
that
what I'm
so
doing.
often. And Monteil and I just had to deal with that exact issue recently, where the back end buyer did not close within 3 days, but was ready on day 4, day 5. He wanted to close, and the wholesaler wanted the property back. Okay, not our job to terminate. They have to terminate that in writing. You can't just verbally terminate, but sometimes a contract can terminate on its own face. But it didn't direct how earnest money was to be handled. And of course, when you have a dispute, we title people are going to say, we want signatures from all parties releasing the earnest money. And of course, again, the wholesaler goes ballistic because they want that money in their pocket yesterday, and we can't do it. So little details like that become important along the way in how we handle that. And so as you look at an assignment, as you're talking with your investor on these kind of things, help them put that together, think through those issues. And again, we're kind of here to help give you some ideas along the way if y'all need those kind of things. Anything else, guys, on contracts just for a moment that y'all want to talk about? Y'all good?
Okay.
Good.
So, another thing I look at is investors and everybody, they keep changing the transaction. There's an initial contract, and then things get changed. I'm doing a deal right now out of Houston, where we're on our 5th revision of the contract. One party thinks it's supposed to be another way, and we're dealing with 2 investors. The other guy thinks it's supposed to be some other way. It goes back and forth, and we draft documents. Then they come back and they change it again. We redraft documents, they change it again. And of course, everybody's hollering because it hasn't closed. Well, it hadn't closed because the parties can't agree to the daggum terms. And every time you change the terms, we've got to go back in and make adjustments and changes. So do your best whenever possible to hone in on your terms and try to get them right the first time. And again, I think we all know that things can change because that's just life in our business. But the better we can be at that, I think your closing agent will be greatly appreciative of that to help you guys out along the way there. Does anybody have any questions about contracts before we shoot on? Besides my 2 gals, everybody good?
I do have a question, if that's all right.
Nope, can't do it.
Oh, well.
Come in. Go ahead.
So what is the best way to have a wholesaler to have those kind of communication abilities? Do you have like attorney in fact, or like maybe special power of attorney from the seller to the wholesaler saying, okay, you can
No.
communicate, or what is the best way to?
Yeah, no, so first off,
Uh-huh.
you say the word attorney in fact, realize an attorney in fact is not a legal document. I don't know what it is.
Mhm.
I see those all the time in novations. We'll talk about that in a moment, but could you get a POA? Yes, but you don't need one. I think the key is in the assignment of contract. The assignor, the wholesaler, needs to reserve all of these rights, so that when he does assign the contract to the back end buyer, whoever that buyer is, that they agree that the wholesaler, the assignor, has the right to communicate with the seller and the buyer, with the title company, that they have the right to receive correspondence, that they have the right to see paperwork. They should have things in there about rescission of that assignment in the event of a non-performance. They should have things in there about how the earnest money is properly handled. So we as a closing agent get good instructions. And the more issues we can eliminate from a deal going south, the better. Maybe the assignment contract terminates if X, Y, and Z doesn't happen. The earnest money is to be paid to the wholesaler assignor upon termination. Is that termination in writing or not? And you don't need the buyer to agree to the release of that earnest money. Little things like that become very viable, I think, along the way out there. So that's how I would do it.
Got it. Thank you so much. Appreciate you.
Let's take a minute and just move into.
Miss Van has a question. She
Yeah.
was raising her hand.
Good morning there.
Morning.
I want to ask you that I see as the TC myself, I see people who come to me and ask for help to really organize the paperwork and what to bring to the title company with more complete document and help you out with understand everything in order. Talking about how transparency with and educate the seller to go into the subject to. So when the wholesaler come in and have a document to sign, just anything that you would suggest or they should prepare before, like seller acknowledgement, seller to understand what they get into, everything you say in there, it should have be in the contract or addendum to it to have,
It
or
should be.
or when I submit in, let's say, hey, I have my client have in the subject to under contract now.
Mhm. I think, so first off, it's understanding that this is truly the investor's responsibility to understand this, not yours as a TC. But so often the investors don't know what they don't know. And so they think that the TC knows everything. And unfortunately, sometimes you don't, which we understand. And we wind up with the blind leading the blind out there. But, just looking through the transaction, getting as well educated on the deal you're doing, whether it's a subject to transaction or a wholesale transaction or a direct flip to an investor that's getting a hard money loan, whatever it might be, is having that knowledge base. So when you look at the paperwork that they have provided to you, you can point out some things that might consideration. It's okay to do that. And it's okay to let them know that maybe there's some things they can do better. And if they're missing some things, just get an assignment or an addendum to the contract. That's pretty easy to do. And just make sure you got enough info there to get the deal done. And then from there, the closing agents are going to look at it when they get it in. And if they're missing something, they may bring that up to you as well.
Another thing I'm asking is a lot of time when I suggest something like that, they will say, can you draw up the addendum? For my part to say
Your
that.
answer should be no, because one, you're not a lawyer and you don't want to practice law without a license, which is what you're doing when you do that. And I'll see a lot of TCs who are very knowledgeable just jump in and start doing all these things. And you're not a licensed realtor. If you are in that state, okay, and you represent them, that's one thing. But truly the investor should be doing those kind of things, not you. Unless you make certain that they understand that you can prepare an addendum, but you're not
But at that point.
But you're
she
not a
would be-
licensed attorney, you can't, do those kind of things, and they should have it reviewed by someone themselves. And it's when you cross that line, there's a problem, because keep in mind, guys, there is never a problem in real estate until there's a problem in real estate. And then there really is a problem. And those are the kind of things that we always want to prevent along the way.
Another question is right now at this point, are we moving to the closing yet? Or are we still on the beginning, to have the contracts before the, I want to ask question as a closing too.
Well, you can ask away. What's your, well,
So this part right here, we can have, let's say at the closing, what document is supposed to be there? You talking about the performance deed and performance note? What document they should expect to see at the closing?
tell you what, let's, well, so what kind of a transaction?
Subject to.
So in a subject to transaction, I am a huge advocate of always protecting our sellers unless we want them to shut down our business. That means there should be a deed from the seller to the buyer. I like to give the seller back a deed of trust to secure performance, so that if the investor fails to perform the transaction, they have a traditional mechanism to regain the ownership of the property through a foreclosure. I see some lawyers out there who don't do that. They don't even have a vendor's lien in the deed. And what happens is, in the event of a default, and guys, defaults happen all the time, the seller is forced to go to court to regain the ownership of the property. The moment you hire a lawyer and file a lawsuit, the investor is writing a check to get out of it, period. And there are, unfortunately, bad investors in the marketplace. Real life example where the had a client up in Fort Worth who sold her house sub 2 to investor 1, and they closed it into a land trust that was going to be a rental property. And the investor then sold the land trust to another investor. Nobody notified the seller of the change. She had no idea who was handling her property, who was there, nothing. And she's in active foreclosure. We get the phone call 3 weeks before the foreclosure trying to help her out. And there's no way to do it. We would have had to send proper notice, file a lawsuit, and maybe in 3 months, lucky, or maybe in 6 months, we might get a judgment against the person to regain the ownership of our property. But by then the house is already foreclosed on. And in that case, she just got foreclosed. We couldn't help her because the deal was not drafted right the first time. So I think there should be those kind of things. We do things very differently than anybody else, where we have not just the legal documents at the closing table, but we have redisclosure documents that we like to have done. Because I believe 90% of this business is disclosure. It's disclosure at time of contract, plus time for the seller to review the contract and seek counsel, and then come to closing in a minimum of 10 days, if not 14. And then at the closing table, because I know our sellers will never seek counsel. They, if they have a realtor involved, forgive me, realtors, they don't know what's going on either. They don't understand this business. And so they don't do anything. And it scares me. And so I like to disclose very well at contract, redisclose at the closing table to protect the investors along the way, and from the sellers and from their short-term memories that happen often. So very important to do those kind of things. So those are the kind of docs you get in a subject to type transaction at closing.
How do I advise the seller on that, or at least point out that they ask me what happened if default, right? And I would say what intersection in the, as only as a closing doc only to say that in there, or where how they feel comfortable. Are you talking about this? If something happened like this, who handled that? How to handle it?
Well, if there's a default, the seller's going to need to contact an attorney in their state to handle it appropriately, whatever that might be. And, I think what you want to do if a seller asks you those kind of questions is, you want to first off make sure they're getting a deed of trust back And it's like you can have a traditional foreclosure mechanism and you roll from there. Now, if you know what the rules are for foreclosure in the state where you're doing business, that's great. Like in Texas, you can foreclose on an investor in as little as 21 days. In Arizona, it might be 6 months. Other states, I got no idea. So wherever you're handling a deal, you need to know what those rules are. So if you do get asked that question, you know what the law is, and then they can go seek an attorney of their choice to get a better answer if they wish to do so. But just don't be giving them legal advice. You can give them actual practical knowledge that's out there and let them handle it in that format.
And you said that is on the closing doc, you have the disclosure right there that it's something a default. They don't have to go through the whole traditional way to go to the court and do that. What else do they do? Is that there was a time they called deed in lieu?
Yeah, well, you can negotiate. A seller can negotiate with the property owner a deed in lieu of foreclosure if they so wish to do so, which is a shortcut to the foreclosure mechanism. And I've never found anybody who wants to get foreclosed on anywhere. But you also have the idiot factor where people just do goofy things that are out there. And so, we always try to help negotiate the deed in lieu if possible, but you also want to make sure you check title before you accept a deed in lieu. Make sure there's nothing out there recorded against the seller that would follow that property back to you. So that's what I would suggest along the way there. So with that, guys, I'm just going to go through some quick things on compliance, just so everybody has a little bit of a knowledge base of that. And again, Texas here is the worst state for compliance that's out there, from what I know. But you need to know what those might be in your state along the way. So with the compliance, I'm sitting here reading my notes a minute, so forgive me. I'm just
You wanted to talk about land trust too, Scott.
yeah, we'll go back into that. So, when you're buying a property subject to the debt, there are very limited issues out there that I'm aware of that need to be thought about, because it's usually is a commercial transaction, meaning it's to an investor, not to a consumer who's a home buyer. But you come here to Texas, things change. There's this thing out there called Senate Bill 43 that went into effect January of 22. And if you're going to handle transactions in Texas, you darn well better know it, because it got really serious really quick. They put a lot of teeth into that thing. And unfortunately, we call it the wrap lending bill. Unfortunately, they define a subject to transaction as a wraparound transaction. And it's just like, holy cow. And what you need to know about that here is that, first off, those must be closed in a law office or a title company, or it's void. Not voidable, but void. Secondly, a seller must, not may, must provide the underlying lien disclosure and insurance disclosure notices in Spanish and English. And these are promulgated forms that have to be provided to them a minimum of 7 days in advance, or the buyer can terminate for any reason they want. This is not a repair option, it's any reason. And, in our world, guys, even though the seller is the party that has liability, sellers don't know what the rules are. They have no idea about this. But I like to make certain that they understand these things, that they have it. And as an investor, we want to put our best foot forward to protect those sellers. So, of course, in our disclosure packages, whether it's here in Texas or nationally, we provide those automatically. And it's just as a fail-safe, make sure everybody's on the same page along the way. Guys, think about closing a sub-2 deal. This is from Monteil and Andrea, about the 7-day provision and closing and funding, okay? We just went round and round that here in Dallas on a deal yesterday, actually. Now, in Texas, we see a lot of wraparound mortgages on the sale of a property. In other states, we don't see it that much because other states, you can do executory contracts, which are contract for deeds, etc., very easily. You can do lease options a lot easier. But here in Texas, you can't. We have various rules and regulations for lease option that you have to think about and understand if your client wants to do that. And if they do, call us. We're here to help you out with those. But why does Texas have so many wraparounds? It's really today because we're upside down on our values and property taxes as to rental. It is really hard to make a transaction work right with a rental property in Texas right now, just because of the value of the property and the property taxes are involved. But a wraparound mortgage allows the investor to cover their down payment and fees that are out of pocket and get a much higher payment that makes the deal work. So that's kind of one of the things I see out there a bit. But if you're handling a deal that is a wraparound, and let's just go specifically a wraparound mortgage to a home buyer or a consumer, as we say, keep in mind, we have the SAFE Act that you have to think about. And what that means is in every state, but for Texas, because Texas has a 3 property de minimis rule, but in every other state, the very first time you do a wraparound deal, your home buyer has to go through loan processing. And what that basically means is they're supposed to be given the RESPA disclosures. That's why you use an RMLO. And the RMLO will provide those 36 disclosures to that back-end buyer to help the seller be compliant. From there, you've got to have a modicum of knowledge of what Dodd-Frank says. I just talked about RESPA, and then here in Texas, the things we just talked about with the property code and the finance code, disclosures need to be out there. Now, if you're closing in our offices, we're going to help you. We're going to ask you questions about this. If you've never worked with an RMLO, which is a residential mortgage loan originator for loan processing in this regard, you can reach out to us here at OFN Processing Services because we process these nationally for you guys. And it's just helping your investor stay compliant along the way. And it just seems that so often the investor has no knowledge of this. And as the TC, knowledge is power again, to make sure you understand those things. Another thing I think you need to do in compliance is if your deal is a pre-foreclosure transaction, you better be talking to an attorney in your state about any of these foreclosure rescue laws they've got out there. I know that there are 21 states that have foreclosure rescue laws, everything from 3 days rights of rescissions up to 30-day right of rescissions to various disclosures you got to do. And they have put some teeth into some of these to make it very serious along the way. So just always, if you're in that a pre-foreclosure and you don't have that knowledge, find somebody in the state where that deal is closing and ask those simple questions to see if they have any foreclosure rescue laws. For instance, Texas does not have any. Arizona does not have any. Colorado has one. And again, there's another 20 states that do. I just don't know what they all are, unfortunately. So be smart.
Hey, Scott, we have a
Pardon me?
couple of questions in the chat. Do you want to look in the chat to see? Randall Patterson has a couple questions.
You want me to find out how to get into chat?
I can
Boy,
read the questions.
I got it. I popped it up. Okay. All right. Who's wearing that A&M shirt today? I got it. So I'm going to talk real quick. When I went back about tax benefits of buying a property subject to where the reinstatement fees, the arrears, are paid as closing costs. The investor, I believe, can write off closing costs in the year of the purchase of the property. If you make it part of the sales price, you can't write it off. It becomes part of your basis. Now, when you sell that property, you get it, but that can be a long time down the road also. So I just like showing it as a closing cost on the settlement statement for that purpose. So the next one from Randall here is, Does Senate Bill 43 for people who own or finance a note for a property that is free and clear? It does not, because it only deals with a property where an existing lien is being left in place. And guys, the bill doesn't define it as a mortgage lien, it says a lien. And you know, I know a lot of investors, I'm one of them. I may leave an IRS lien in place. I might leave a judgment lien in place for various reasons and things like that when I buy a property. And so that's a lien. So therefore you must think about compliance with that along the way. Seller carryback transactions. This is where a investor is buying a property and they're asking the seller to provide them a second lien after closing. Anybody dealing with those today? Has anybody dealt with them? Well, I know you do, Monteil. They call this thing the Morby method, is the colloquial term I hear out there. And they first started doing this, guys, a couple of years back, or a year ago, whatever it was. They were trying to do all of this at one time at the closing. And what the situation is that an investor is buying a property. They're getting a DSCR loan, debt service credit ratio loan, which is an investor hard money loan in the traditional marketplace. And they were wanting the seller to take a chunk of their net proceeds and provide that to the buyer that they can use as their down payment. And of course, the first thing that comes to mind is no, that's mortgage fraud, unless your lender has full disclosure of that and approves it. So fast forward a little bit. Today, what is ongoing is that the investor now goes to a private lender on Monday, and they'll borrow $100,000 from that private lender for a couple of days. And then they close the DSCR transaction using that $100,000 as their down payment, let's say. Now, in the DSCR world, that is completely fine because these loans it's not a financially documented transaction. They're not looking at the finances of the investor. And the DSCR lender is not sourcing the down payment, meaning verifying where that money comes from. They don't ask about it. In the traditional mortgage world, they do ask for sourcing of down payments. They want to see the last 3 months of bank statements. If you got that money, where did it come from? Has it been there for a while? Has it seasoned out? Is it a gift? If so, get a gift letter, things like that along the way. But in the DSCR world, they don't ask for it. And so if they don't ask, you don't have to tell, and it's okay. But the investor still wants to control the seller's money, dictating what to do. And that's where I think you can get into a little bit of trouble. And so what we like to do on these is to have the seller give the title company, the closing agent, direct written instructions. I don't want to see it in a contract or those kind of things. I want direct written instructions in an email from the seller directing the closing agent where to send their money. I don't want it part of the contract where the investor tried to control the deal. I think you can get in trouble doing that, and we don't want that to happen. And then secondly, so you close leg one just fine, and then separate and apart from that, we go out, we want to close the back end, and now we want the seller giving direction as to what they're asking party number two to do. We want to draft a second lien. Here are the terms and conditions of what we're asking to do. So it becomes an independent transaction of the original closing. And I hope you all can see what I'm talking about here. I'm trying to just get a little bit of separation out there on these types of deals so that the parties everybody's protected. That's the main thing. And I know exactly what investors are trying to do, what they're trying to accomplish. And it's making sure that the seller understands that they're getting a second lien mortgage, not a first lien mortgage. Had that exact thing happen a week and a half ago, where the investor who did a second lien thought he was in first lien position because his existing mortgage when he sold the house was paid off. And he said, well, I'm in first lien because it was paid off. I went, dude, no, you're not. Look at the documents that you have. It clearly says you're a second lien mortgage. It clearly says it's secondary and subordinate to this first lien mortgage out there. You're not. And unfortunately, the investor defaulted on the DSCR loan, and that property was foreclosed on, and his second lien was wiped out. So we just want to make sure that everybody is on the same page. This is getting to be more and more and more popular in the industry. And if you haven't dealt with it, you will. It will pop up. And having a knowledge base is so important of that. I can tell you that Monteil's pretty well versed. Andrea is very well versed. We are. If you've got questions on that, reach out to us. We're glad to help you out, make sure you understand it better. So make sure you just navigate those transactions properly. And the key is really protecting our investors so they don't go out there and stub their toe. We don't want them to commit mortgage fraud or those kind of things. And done the right way, we think it's okay. We just want to make sure everybody's on the same page. It's all about full disclosure, and you move on from there. Let's talk a minute about our closing process, guys. How we go through this on a step-by-step basis. So I'm going to let Monteil and Andrea kind of pipe in here a little bit in what they like to see. So when you guys are getting a contract going through on this, what is it y'all like to see the TC provide to you? Because so often we're getting this information from the TC today, not necessarily from the individual investor.
Go ahead, Andrea.
Okay. Upfront, as much information as you can give us, along with the contract, the current or most recent mortgage statement, like we were talking about earlier. If they are in arrears, understand the difference between a mortgage statement and a reinstatement. If they are severely behind, if they're very delinquent on their mortgage, we've got to have a reinstatement. Even if they're not in foreclosure yet, there may be additional fees and everything. So understand that and know that we're going to need that up front. I have actually seen it where you go to close, or you have a mortgage statement and it says there's $7,000 in arrears. We have the seller request an actual reinstatement, and the reinstatement figure comes in at $12,000 or $13,000. So imagine, having to come up with an additional $5,000 at closing or something that you weren't expecting. So just knowing the situation with the property at the time you're submitting the order, and getting us, we'll need, if it's an investor, either the buyer or the seller, we need LLC docs, articles of organization, letters of good standing. We need everything about the LLC that they're closing in, upfront, mortgage statements, reinstatements, like Scott said earlier, insurance information for the disclosure. And just if you can get us all of that at the time you open the order, oh my gosh, and we appreciate that so much. And then also making sure that we have both the buyer and the seller contact information, phone number and email address. And if you know it at the time, because we will ask for it down the road, we also need buyer and seller's marital status.
That's kind of important. And guys, just to pipe in on the marital status a bit is, for instance, here in Texas, we are a community property state. So often we'll see a deal where the husband is entitled on the property. Maybe he's been entitled for a long time, but he's also married. And there's going to be a presumption of community property. When did they get married? We don't know. Was it last month, last year, 10 years ago? And every closing agent, at least in Texas, is going to add the wife onto the deed, at least pro forma. Now, if there's a deed of trust to secure performance being issued from the investor back to the seller, that's fine giving it just back to the husband because he's the guy who's on the mortgage probably. But we're going to have to include the wife pro forma, as we call it, on that deed. And I've had people complain about that all the time. Well, why does she need to sign? I own the property. But it's like, what's the old adage, out there? What's hers is hers and what's yours is hers too, is how it kind of goes if you're a guy. So you need to know what kind of estate you're in. Are you in a separate property estate or a community property estate for that purpose out there alone? As I said earlier, getting all the docs in, so important at one time. Helping, maybe if you can get a copy of the underlying note deed of trust, that mortgage statement, getting that over at one time. All these little details like that, because the faster we get that in, the faster we get the ball game rolling going forward. And so often we get hollered at because the deal's not moving fast enough. But 85% of the time is because we're not getting the documents we need. And maybe it's because either the investor, the TC, doesn't have them, but we just don't have them ourselves, and we need to get it. And when things come in piecemeal, it's start, stop, start, stop, start, stop. It just slows everything down to a crawl. So the better we can get that in, the better it is across the board for any closing agent handling a closing of a transaction out there. And, again, I said this earlier, changing the terms of the deal, and I get it that the deals change, but the more accurate you can get up front the first time out of the chute, the better. Just little things to think about too, if you're a transactional coordinator, is, oftentimes the TC is working on one or two deals at a time. And keep in mind that your escrow officer, your closing agent, they may be working on 100 deals. What happens to me is I'll talk to an investor last week, last month, and they'll call back ready to move forward. And they just start talking about the deal. And it's like, okay, guys, time out here. You need to bring me current again, because I don't remember what the heck we talked about last week or last month. It's just, when you deal with, hundreds of properties at a time, phone calls, emails, texts from investors everywhere, we don't follow that until we're keyed into it. And so help your closing agent by bringing them up to date on the deal, just basics along the way there that will help them get that going. I think it's a great benefit for them when you can do that. So keep that in mind. All these little things add up. Another thing to bring up is loan servicing. Now, if your investor is doing a sub-2, they want that to be serviced, that's fine. If you're doing any type of a wraparound mortgage, they want servicing involved, that's fine. But one thing we ask is get with your loan servicer in advance of closing. If you need loan servicers, we certainly have great recommendations we can provide to you for that nationally to take care of transactions. But don't ask the closing agent to fill out your loan servicing package. I don't want any of my offices doing that, because I don't want the liability for making a mistake and putting something in there inappropriately. I have no objection to providing the closing package to the servicer upon request, because once the deal is done, we're going to scan that in and we can push a button and send it wherever we got to send it to. But you want that loan servicing package filled out in advance of closing so that both the seller, buyer can execute it, whoever that might be, whether it's whatever type of transaction it is. And that way it's done all at one time, not after closing, because then people scatter. Get it all done up front. It's not a hard thing to do, just a little bit of organization and it gets going. And then the other thing I think too is getting your insurance set up prior to closing, letting your closing agent know in advance how you're doing this. In other words, I prefer to have the insurance policy prepaid and just provide us a copy of the paid invoice. Done. We don't need to see a copy of the insurance or anything else of that nature. Or if you're going to have the investor or the back end home buyer provide insurance, get paid at closing, make sure you get us that invoice so we can put it on there. And then if there are any other invoices, such as your invoice, we need that. Guys, what else should the TCs be providing to y'all at closing to help out?
Andrea touched on all the good stuff. Like she was saying though, if those numbers do change, having those amendments prepared for us, a lot of the times like the investors expect us to put those numbers together for them and then they prepare the amendment. Although we handle a lot of transactions, that's not technically our job for you guys, is to make it make sense.
Yeah.
So.
And I know that Andrea has been hollered at a couple of times where some investor will call up going, well, XYZ title company does all this for me. And I go, great, they can take the liability for it because we don't want to do that. And they get a little bit uppity about that. So I think just that little bit of stuff in advance is loan servicing packages, guys, are easy to fill out. They're not hard to do. But just getting whatever the invoices are along the way, ensuring we know the numbers helps to get that deal put together and get it closed quickly for y'all. And that's really the ultimate goal, is get the stuff in there, get it on the HUD or the CD quickly so we can make that happen. I just want to move next into some title consideration, guys. And I think it's so smart that if you are in, it used to be, guys, investors only dealt in the state where they are. Today, they cross the state lines everywhere. And so when you're going to be doing that, and I'm going back here trying to read, I'm going to stop a minute, guys. I'm going to read some questions here. And this is from Karen. Does a TC or the attorney have a checklist of information wanted? As an investor, I've created these for different types of sale purchases, but not, I don't know if Monteil or Andrea actually have those. That's not a bad idea to have a checklist of things that should be provided in advance of the closing that can be checked off on. So Monteil and Andrea, it might be something good to think about, is a checklist item of things that the buyer should ensure we have, whether it's
Isn't that included in your PMP package for the law firm?
well, it is for the documents for contract purposes. But no, if you've got an HOA invoice, for instance, and guys, if there is an HOA in the property, make sure you have your HOA addendums completed, who's paying what, that has been filed appropriately in there so that you're meeting your state requirements for providing HOA information out to all the parties. But we could do a little checklist. I think that's a good idea to have. Randall had a question.
Can I make a quick comment in regards to HOAs? Make sure in the contract that it's spelled out, because I've seen this happen and we get into a dispute at the tail end where the contract is written to where the buyer is paying all closing costs. Well, then we get the HOA demand in and the seller has $5,000 or $6,000 in delinquent HOA. And they think the buyer is going to pay that. But that is technically not a closing cost. It's a buyer, or excuse me, it's a seller liability from years ago. So we need that all spelled out. If the seller has delinquent HOA, they're probably going to know that, and we're going to need to address that up front. I don't want to send a settlement statement out with a huge chunk of delinquent HOA shown on there and I'm charging it to the buyer, and the buyer, because I've seen it happen. And the buyer says, no, I'm not paying that. And it can kill a deal at the tail end because there's no money left to give for that HOA if they weren't aware of it. So just be mindful of that if there is an HOA on the property, which here in Arizona is probably 90% of every property, that we know up front if there are delinquencies and who is going to be responsible for paying those.
Awesome. Yes. Take a moment, guys, too, whether you're the investor or a TC. Again, know your state's requirements of things that are out there, expect and anticipate them. Everything from transfer taxes, ask questions of a title office in that state somewhere. You know, are there any witness requirements? For instance, we learned a while back in Florida, on a deed, you need 2 witnesses, not 1, but 2. Some states have certain recording information they want. They want to use their certain forms along the way, whatever it might be. Are there transfer taxes due? What does that look like? How do you calculate it? That's a big one in a lot of states. You need to make sure you understand along the way. And just, is there anything special that's out there? I think finding that knowledgeable attorney or title office there and just asking some simple questions. One thing that we try to do, and things that we've learned, is every state has different requirements that are out there. And sometimes it's even county by county changes. You know, for instance, in Alabama, Henry, just to bring that up to you, is, you know, they don't have a state promulgated contract. The counties do their own contracts there, it seems like. All these little details, but having a knowledge of where you're doing business can certainly help you out along the way, and share that with the closing agent. You know, we try to call every county where we're doing a deal, verify and validate this, and we track it along the way. But it doesn't mean we're getting everything all the time. And we want to make sure we're not missing anything, because again, it helps the transaction flow. On a deal we did a while back in Florida, you know, we submitted the deal for closing, not knowing you needed 2 witnesses. And of course, they don't send it back by email or anything else. They send it back by snail mail. So it takes a week to get it. When we get it, we get a witness put on there, send it back in. Well, no, you don't need 1 witness, you need 2 witnesses. Again, you get it back by snail mail. Now 2 weeks have gone by, the deed hasn't been recorded. And, you know, people start screaming because of that. So any way we can all work together to help out, it just gets these things flowing more smoothly, which is what all of our ultimate goals are along the way. I also think having some basic knowledge of liens in your area, because as we're pulling title searches, liens will pop up. These could be child support liens, IRS liens, judgment liens, mechanics liens, and whatever it might be. And guys, we got you covered here in Texas and Arizona. We know what they are. You ask me what it is in North Carolina or Georgia or Ohio, I ain't got a clue. When these things pop up, we refer that back to the TC and or the investor to seek out an attorney of their choosing to do that. Now, if we're providing title insurance on that transaction, we can go to our title provider, and I'm sure they're going to be able to assist us with a knowledgeable attorney to help navigate those liens appropriately for you. We can provide those referrals out there, but the more you have working knowledge of the state where you're doing business or states you're doing business, I think it just adds to you, just to your abilities to be better at the game. So if you don't know what those are, take time to learn them. And you don't need to be an expert on them. Just having a knowledge base helps out. And then share them with us so we can help you guys along the way as well. Now,
Hey, Scott,
yeah.
can you touch on earlier when you were talking about you like the insurance being paid up front? On the sub 2, Randall has a question. If you already have that insurance in place, what are your thoughts there since it's already in place?
When if an investor is buying a house subject to, the seller is going to have insurance. The problem is that seller is the insured on that policy because they are the owner. When you buy the house, you become the owner. You don't leave that policy in place unless you can be added to the property as a co-insured. And so oftentimes, and let me back up too, that policy is most likely a homeowner's policy. And when you're buying the property, it's going to be a rental property or something different along the way. And so if you're going to use that property, if it's going to be if you're buying it to live in, maybe you can see if you can be added on to the policy. If not, you need to get a new one. But if you're going to be holding it as a rental property, Airbnb, short, long-term, midterm, whatever it might be from a rental perspective, fix and flip, maybe you should be getting a new policy where you are listed as the primary insured and your seller, of course, as a co-insured along the way. And sometimes they'll put them on there as an additional insured, but the key is having that there. And the last thing I'll say about insurance too about this is do not have two policies. When you place your new policy, your insurance company is going to send it to the lender. Make sure you then, utilizing your power of attorney with that seller or working with the seller, cancel the old policy. If you don't cancel it, you're paying for two policy guys. So make sure that first policy gets canceled, okay?
He's asking his questions around that in the chat. Will you refer to that really quick?
Say that again, please.
Will you refer to the chat? He's asking you questions around what you're speaking on.
Yeah, I'm going through that right now. And of course, Kim, it's okay to reach out to us about these things along the way. Always happy to help with that.
Yes, you can ask live.
Yeah, we handle all of that. Let's see, from Van, did we do that?
Hey Scott,
Got it.
it's Randall. Hey,
Yeah, Randall.
I understand that about the insurance, of course. My main concern was, because you refer me clients all the time, is when you said you're going to have the buyer who's buying the house.
Randall, I just realized who the heck you were. I'm sorry.
Yeah, it's okay.
Brain fog, brother.
Yeah, it's okay. I figured, but it's not a problem. So when you refer me somebody, we're setting it up subject to. I get all that. The thing that kind of flipped the light bulb in my head is you told the client you want the buyer buying the house subject to cash up front. Well, there's an escrow with that loan that has money in that escrow account. That lien is still going to be in place. So they paid the insurance up front. We wrote a policy for it. Then we're going to switch out the old policy with the new policy. But now there's like a double payment, because I just had this happen just recently. There's a double payment in there. So is that the way? My question is, we can work out the double payment and I can understand how to fix all that. I understand how to fix all that. But if is that what you recommend your clients to do, so I can give them the correct advice so that we're telling people the same thing in that whole entire process? If that's the case, then I'll say, hey, you pay it. There's an escrow account there. There's going to be a double payment, but that money will come back to you. It's not like they're out.
Absolutely. So by the way, insurance is insurance, and it's something that the investor does not control. The insurance companies do, and the lender with an escrow does. So the key again is just making sure as the new policy is sent to the mortgage company, give it a week or 10 days, then cancel the old policy once you know your policy is in place and has been provided, so that the lender has that, and then terminate it. And could it take the mortgage company a month or two to catch up with all that? Sure, it can. And could it possibly be that there is a double payment somewhere? Sure, there could be. But as you said, Randall, absolutely, that money will come back. I'm going to talk a bit about the back end navigation of that with a mortgage company, how to ensure that that money does come back to you and not to the original seller in those situations. But for all of y'all listening, Randall, by the way, owns a company called Sergeant 55 in Plano, Texas, here in the Dallas area, and is awesome at the business, because not only does he understand this, he's an investor himself and does a lot of this business. So somebody good just to work with should you need an insurance recommendation along the way. I'm just trying to scroll through some questions, make sure I'm answering all these real quick. Okay. So title insurance, oftentimes we don't get told up front whether title insurance is going to be obtained or not, or you just want an abstract of title. And something that's really important that you would have thought I would have done this years and years ago, but I'm just not as smart as I look. Okay, guys. When we get a transaction in, if you're not asking for title insurance, we're going to pull an abstract of title. Well, if we pull an abstract of title on October the 1st, and the closing is scheduled for October the 30th, we're not going to order another abstract a few days before closing. We call that a bring to date. And the reason we don't do that is it's going to cost you an extra $350 to order that abstract. Well, in the title world, a title company, when they open title October the 1st, the week before closing, they're going to do what's called a bring the date or a down date or other thing that the verbiage might change state by state a little bit to check on things. They are mutually exclusive, though, unfortunately. And in fact, we have a new document that we are now incorporating up front with all of our transactions just to put the investor TC on notice of that so that they understand that we're not reordering that. And I bring this up because about 8 or 9 months ago, this exact thing came up. And of course, I sit here and go, why in the world didn't I think about this 13, 14 years ago as all this stuff was changing in the marketplace? And had a client in South Carolina where we couldn't get title insurance on the deal, but he thought it had been assigned to the back end buyer. Well, of course, the wholesaler knew that we weren't getting title insurance, but the back end buyer just assumed they were getting title insurance and they were getting an abstract of title. Well, about a week before closing, a judgment lien hit the property. And you're going, oh my gosh, what's going on here? Well, luckily, they're just like here in Texas, there are some ways to eliminate judgment liens, and they don't affect a certain percent of the property. So it was able to be navigated easily. But having that knowledge base is so important. And, if you're not going to get title insurance, if you do want to have a bring to date on an abstract, the abstract companies don't just do a bring to date. They charge you for a whole new abstract, unfortunately. It's just the way the industry appears to work. So keep that in mind. It's important to understand that. And, understand timeframes also. Typically, when we're ordering title insurance in Texas and Arizona, we can get stuff in 2 or 3 days, typically, sometimes 4. If we're ordering it nationally, it may take a day or 2 longer. So this doesn't come in as fast as we'll always want it, but it's not us controlling it. It's just that you have to order it and get it in. And so it just doesn't move as fast as we always want to. As I said earlier, when we get the abstract or we get the commitment in, we're going to share that with you. But everything changes. And of course, curative issues can pop up. So if there are items on the title that need to be cured, just remember, we're going to do our very best to put you with an attorney in that state who can help you and or the investor navigate that appropriately so you get it done. In Texas and Arizona, we got you handled, but other states, we have to reach out to third parties to help you do that. And again, having that knowledge base on your end, as I said earlier, is always a benefit along the way. Another thing to think about is this. It's frustrating when we get asked by someone to review the documents the day of closing. And all that does is slow it down, because we're happy to send documents to anybody who wants them in advance of closing. So try to ask in advance. If someone wants to review it, do it. From there, if you want to change the documents, that's fine. Just realize we can put in or take out of a document whatever y'all want to do. We do not represent the seller or the buyer as their attorneys unless we are so retained to be an attorney. And again, for me, I can only do that in Texas. And as I find, nobody wants to pay my fees, unfortunately. So I would love y'all retain me here in Texas and pay me these great fees to tell you the same thing I'm going to tell you anyway. But I like new boots a lot. So anything y'all can do in that regard, just realize we'll change the docs for you, but we can't tell you whether it's enforceable or not. We just don't have that ability. So understand those kind of things and how you do that. And if you do want to see the docs in advance of closing, especially the settlement statement, reach out and just ask. And I'm sure everybody is certainly willing to do that. Guys, anything else on title considerations? Andrea, Monteil, you want to bring up at all? You all good?
I'm good.
I'm good. You have a couple of hands raised for questions.
I am. Okay. I think I got them all answered, Monteil.
No, their hands are raised
Oh,
in chat, like in the screen. Yeah.
okay. I got it. Go.
I do have a question in regard to the end of the transaction. Let's say I purchased the property subject to from the
Yep.
investor. He's very aware of all the stuff and everything just went fine. And we put it into the land trust. Now I'm thinking about to wrap it to the end buyer. What documents, can I just use it as a land trust and to transfer to the beneficiary interest, or should I do something else?
Okay, so
I'm in Georgia.
you're in Georgia. So don't know the trust laws in Georgia, but I'm sure if it's a land trust, it's probably the same stuff. So while we're on land trusts, I have no objection to using a land trust along the way. I'm not a big fan of these things called a pact trust or other trusts where the seller retains an interest in the property. It's just way too confusing to explain, in my opinion. But if the back end buyer is going to live in the property, if they're going to lease the property, if they're going to fix and flip the property, I have no objection putting a property into a trust. On the flip side of that, though, if you're going to sell it with owner financing on the back end, I'm not a big fan of using a land trust up front. And the reason why is you can buy the property sub to into the trust. Now, if you're just going to sell the property sub to the back end buyer, that's fine. You know, we have documents that regarding the sale of the beneficial interest that we utilize, where beneficial interest holder 1 is selling to the back end buyer the beneficial interest. So yeah, we've got that and can help you with those kind of things. A lot of times investors will ask me, and keep this in mind, guys, if you're selling a property out of a land trust with a wraparound mortgage, you're violating due on sale all over again. And so I'm not a fan of doing that. So I usually don't want to put it in a land trust up front. We can do that. There's a lot of ways to reinsert your LLC back in the transaction through some fancy footwork, but it requires a lot of documentation. And it's going to cost you guys a lot more money to do that. And so because due on sale happens so seldom, in my opinion, I'd rather not deal with that until we have to deal with that and just be smart along the way there. So I'm just going to go real quick into back end strategies on a sub 2 deal. And I just want everybody to understand, do as much as you can do online or through the seller. I'm not a fan of sending mortgage companies POAs or authorization forms. I don't want them seeing or doing anything if we don't have to. And so I want to get the passwords and those kind of things. For instance, as we mentioned earlier, if you need to get a reinstatement, get the seller on the phone with you, call the mortgage company and order it, help them do it, help them navigate it. Whatever it is you might be, call the law firm that is handling the foreclosure, get it from them, get the details, be there as a benefit to help them get it done. Y'all don't think bad of me here, but sometimes when I have the seller's name, their date of birth, their social, the mortgage statement, etc., can I call and just pretend to be the seller to order it myself? Sure. Is the mortgage company going to know anything different? No. Is there anything wrong with doing that? I don't think so. I just don't want them to have any inkling that that something's going on in the transaction. And the less we call the mortgage company, because everything gets recorded, the better. And so as you're talking to your seller, you know, you want to get their online password if they have one. If not, let's create one. You know, you want their cell number because oftentimes these mortgage companies are doing dual authentication now. You want to, when you buy the property, go online using that password, change the address so that the mortgage statement comes to the investor who bought the property or the buyer. Change the phone number so that cell number will be called or notified for that dual authentication purpose out there. Do your best on the back end to make your payments timely. Do as few things that create red flags with that lender. You know, as we said earlier, handling the insurance properly the first time out of the chute, so important. Handling your payments, so important. And I tell investors all the time that if you don't have money to carry the debt load on a sub-2 deal for at least 6 months, you shouldn't be doing a sub-2. So many investors think they can buy a property on Monday, on the 1st, and they're going to have it sold on the 15th or the 30th. And that is not true today because our time frames have got much extenuated. And so you got to make sure you have the ability to carry that debt load until you get an income producing in some format. And we want to make sure we protect our sellers and realize that we're dealing with their credit, not ours. And so doing the right thing is so, so important in that regard. So handling that back end on a sub-2, getting all these details done, so important. And setting that up. And so lastly, guys, I just wanted to go into some things with some special topics I'd come up with, and we can talk about these a little bit. We talked about assignments earlier already, which is important, and how to navigate that appropriately. If you are doing a wraparound mortgage, and we've talked a little bit about this, that is to a consumer home buyer, it's understanding you have to process that buyer with the residential mortgage loan originator. It's not an option. First time in every state, you've got to do that. Texas does have a 3 property de minimis rule, but we do it anyway because it's the right thing to do. And keep in mind that a loan processor is not the lender. We are a document gathering firm on behalf of the seller who is the lender in these cases. It's something that our Texas Savings and Loan here doesn't understand, unfortunately. And I bet you anything other states' savings and loans don't understand that either. But the RMLO will basically underwrite the buyer properly. And I see, Kim, you still got your hand raised, kiddo?
Yes.
What's up, girl?
Oh, okay. So, going back to the insurance, I hear people saying, "Oh, you don't want to have 2 insurance
Oh,
because."
no. We call that a cat fight.
Okay, but my point is though, you don't want to have 2 insurance because when the house catches fire or something happens, the insurance people will say, "Okay, get the money from the other insurance first before we pay out," or vice versa. So it's like a ping pong ball. So they said you don't want to do that, is what I heard. Can you like maybe talk about that?
Well, you know what? I'm going to turn that question over to Mr. Patterson, who might be the expert on that.
So great question. What happens is who has the insurable interest? Scott mentioned just a few minutes ago that when you buy that property sub-2, that you may have a different type of policy now because now you're renting it out. So the homeowner's policy that was there before is now void. That person that sold so how it works is real quick. When you buy a house sub-2, whatever insurance policy there is now void. It's done. It's because that person that lived there sold the house to another individual. So that person no longer has insurable interest. So now you, the buyer who bought the house sub-2, has to have a policy in place. It's either going to be you're living there or you're going to be renting the property out. That it needs to be a landlord policy. So if you have 2 policies, they're going to look at who has insurable interest. Then the other policy who doesn't have the guy policy has no insurable interest, that's gone. Then they're going to look at the next policy. Okay, is it the proper policy for the proper use? If you've got a homeowner's policy and you're renting it, you're going to have issues, and then it's going to be a judgment call of the adjuster who's adjusting the policy if they're going to take liability and pay out a claim. So it all boils down to what Scott said at the very beginning. When you're structuring your deal, you got to have all the facts. And one of those facts in the very beginning of the meeting, he said, you got to have the named insured, the buyer's name. You got to have the seller's name. So I need the buyer's name and date of birth. I need the seller's name to be on the policy as an insured, not the main named insured, but as an insured. Then you gotta have the correct mortgagee clause on the current loan. And then you're gonna have the next one is gonna be the other insurable interest. Your entity, your second lien holder, or if you got a mortgage servicing, I can have as many lien holders as I want on there, as long as that the original note holder is in the first lien position. And then the other problem we heard was everybody's scared that the note's going to be called due as soon as we notify the lender. Man, those guys are in India, the Philippines, wherever they're answering their phone. They're just checking the box. I've seen it 1,000 times. Scott sends me a lot of business. Thank you very much, Scott. But everybody's concerned about the note being called. The new buyer is the named insured. The old owner of the house is just on the policy. He has to be there so that when that policy goes to the mortgage company and they're checking the boxes, oh, there's Mr. and Mrs. Johnson. Oh, who's in the first lien holder? There's the first lien holder. That's all they're doing is checking the boxes, and it moves on about its day. I mean, I just got one that was kicked back because the first lien holder wasn't correct. They didn't say anything that it's got a different client now, and then it's the original client was there. They didn't care because the original client was already on there. They just want to know that the first lien position was corrected. I corrected, I sent it back in, no problem. But that's how that's going to work. No, there's not going to be ever any double pay, period.
Okay, because sometimes I hear, oh, you want to keep the original because you don't want to raise the red flag. So now we'll just get a new one out. And then so we'll be like double covered as a buyer. You know, I have my own. And then just in case something happens, then the seller, you know, I'm covered there as well. And then it won't raise any red flags because it still shows as the seller as the, you know, the owner of the whatever. So it just avoids that red flag. So you're paying
That's
twice.
wrong. Whoever told you that's wrong.
Okay.
So when that person, if what was your name again? It was Alex?
Yes.
Alex, if you're buying my house subject to, and I have a homeowner's policy on it, I sold you my house. I have an insurance policy as a homeowner's policy. I sold you my house. I no longer own it. I no longer have an insurable interest in the house. I no longer own it. That policy's done. Now you just bought it. What are you going to do with it? Are you going to live in it or rent it? If you're going to rent it, then you need to get a landlord's policy in Alex's name. You're the named insured. My name will be on that policy as a name placeholder only, because you just got a power of attorney and all those documents. That's going to say all those, anything with the claim or whatever, all goes to you. Scott just told you all those authentication numbers of the mortgage all goes to you. And the first lien holder on my loan that I had has to go in the first lien position. And then there's will be a second and third based on whatever you set up. But whoever's telling you that is wrong. It's got to be done this way.
But don't
Okay.
believe everything you hear on the internet, guys. Hey, Wesley, what you got, bud?
Okay, quick question, Scott. You mentioned about the land trust, and he was talking about the insured. So if I'm hearing this correctly, if I set up a land trust for a property I'm going to hold long term, from a sub 2 deal that I'm buying, I need to make sure that insured policy or that policy has the seller's name, the seller's on it as well, and I need to make sure that in advance that the land trust has a policy as the client for that property. Am I
Yes,
am I understanding that correctly?
Yes, it is. I would have the land trust would be the insured because they're the owner of the property. And the seller would be, of course, your additional insured, just as Randall had pointed out earlier for you as well. And then, of course, the mortgage company would be the primary loss payee.
Okay. Great. Awesome. Thank you.
Great, man. Just real briefly, guys, novations. I'm sure you all deal with novations. A lot of investors do that, getting things done. Just the tidbits here for a bit, because everybody does things differently, and I get it. On our website, OFN National, which is OFN, the ownerfinancenetwork.com. I've got probably a 20 or 30-minute video about novations on there, which is the best way to protect you, and then other steps on down to the least. And I understand that investors do this to circumvent the 90-day rule. They're circumventing realtors. I understand all that. I get it. They also are trying to do things as easy as possible with as least issues. I had a guy yesterday call me who was doing an ovation, had put $30,000 in the property, zero protection other than a contract for sale. And I was just pointing out all things that could happen, and it kind of opened his eyes a little bit. But there are various ways of doing this. Understand that an attorney in fact document is not a power of attorney. It is not enforceable. I do like to use a POA if and when possible. And if you're going to work with novations with your investor client, make sure there is a defined structure of payment to the investor that an escrow officer will understand, that they can easily calculate what that is based on the numbers, because they can't guess at it. And so just be smart there. We're here to help you out with novations. If questions arise, we can always reach out to us, and we'll do our very best to advise along the way. And from there, every deal is different because every investor and every seller is different. I get it. You know, as a lawyer, myself, an investor, as I said earlier, I understand the nuances. I'm always trying to cover my butt the first time, but at the same time, sometimes you just take the path of least resistance and you're willing to take the risk. I get it. You know, we understand it, and we're here to work with you, get your deals done, understand all the reasons. And lastly, I just wanted to bring up, let's see here, UCCC, I guess that's a typo, guys. UCC liens. We're all seeing these, especially solar panels, and it's a pain in all of our rears we have to deal with. I got lucky the other day, Andrea, we got on the phone with the head underwriter for Stewart Title for both Texas and Arizona, because this thing is a major moving target. We think things go one way, they don't, they go another way. So let me kind of just outline for y'all the best I know about UCC liens. So first off, here in Texas and Arizona, and probably nationally, UCC liens are a lien on personal property only. It is not a lien on real property. They have the right to come and get it. So because it is a lien on personal property, you cannot take a UCC lien sub 2. It is not something you can do. If you want to take over that lien, you call the lender, you execute the paperwork, and you become the party to have responsibility for making those payments under the note. So I see so many contracts that come in where the investor is taking the UCC lien sub 2, and it's just understanding it's not a lien on real property. You ain't taking it sub 2, guys. Next is ensuring you explain to your seller what you're going to do with that. When I'm buying a property, there's a UCC lien, I am not taking over that lien. I am not taking the responsibility to pay it. I am doing nothing with it. I might have an agreement to make payments temporarily, but I will not take the obligation of doing that contractually or legally through the lender. And again, every deal is different. Every investor is different. But if you choose to do so, identify it as such in the contract, where the investor is going to contact the lender for that UCC lien and take on the obligation, and do that before closing. Now, since most investors don't want to take over UCC liens for this topic, it's ensuring the seller understands that completely. And then how is it handled from a title perspective? And this is so important, I think, because title companies are now not wanting to remove them from the title work, your commitment. They're wanting to move them to Schedule B, which are your exceptions, or whatever that schedule might be in your state. For instance, in Arizona, Schedule C is your exceptions. And they're going to leave that UCC lien out there. I don't know why they're doing that. I'm guessing it's for notice purposes. I don't know. If there is a foreclosure, does it wipe out a UCC lien? Well, the school of thought used to be, yes, it does. But think about this, guys. If this is not a lien on real property, a foreclosure is not going to wipe out a personal property lien. So it's still there, and they're wanting to put these on Schedule B today. That means if you're getting a new loan on that property, since it's a lien on personal property, that new loan should be in first lien position. In talking to Stewart Title, they indicated what they're wanting to see today is not a partial release of the UCC lien as to the real property. They want to see what's called a UCC1, which is a full release of that UCC lien. That means that the lender is releasing it both on the deed records and from the Secretary of State's office. Now, if you're able to get that accomplished, that's great. Hard to do, hard to communicate with these UCC lenders. They don't return phone calls hardly ever. And all they really understand, it seems, is brute force out there. And, if you're lucky enough to get a UCC1, once you buy the property, they're free to go back and refile that UCC lien somewhere, because their client who signed that UCC lien is no longer the owner of the property. And of course, they're free to refile it with the Secretary of State's office. Today, what we're seeing as the prevailing winds is an attorney needs to provide the lender with a demand letter, and typically with a lawsuit ready to be filed, where if they don't file a UCC1 and remove it from deed records, that they will get sued. And these lenders are not going to do that because they know they cannot. The filing of a UCC lien in deed records is simply improper. Filing it with the Secretary of State's office is the proper mechanism, but they do this to cover their arrears, even though it's wrong. And I think they're subject to liability if they don't release it. And that just seems to be the prevailing mechanism that is out there today. So again, it's a moving target. I don't know 100% what's going on these things. I don't think anybody does, but that is probably the best explanation I can provide you guys on any type of a UCC lien, whether it's on solar panels, water softeners. I've seen them on HVAC units. I've seen them on tankless water heaters. And it's just realizing what it is and knowing how to navigate it properly with your seller and or your investor to make sure they understand this equally.
Scott, I got a question on that. So we're talking solar panels. You said HVAC, water softeners, but they're attached to the house. And when they permanently attach them to the house, does that not become like real property? And it's not personal property?
To the best of my knowledge, no. And it can be a fixture, but there's a long list of what is a fixture and what is not a fixture. For instance, kitchen cabinets are not a fixture. Countertops are not a fixture. They can be removed. Appliances aren't a fixture. They can be removed. You can unscrew cabinets from the wall and take them with you if you then get paid for them. And so most states have a long list of what is or is not a fixture, typically with a mechanics lien property. And so things like a tankless water heater can be easily removed from a house. A water softener can be disconnected. Solar panels can be removed. And it's a touchy subject that you keep hoping states deal with this stuff appropriately and make some changes, but they have not done it yet. And so for now, it's just kind of understanding the things that I laid out is what we've heard from underwriting. And again, different underwriters may look at it differently also. It's just one of these things that we don't have a definitive direct answer for, unfortunately. And Andrea and Monteil, does that seem to be accurate from y'all's perspective too?
So yes, in regards to how you explain the fixtures, the UCC1 is actually the filing of it. The release for it is called a UCC3. So that would be the only thing.
Thank you for that.
You're welcome.
I learned something new today. Anything you're in, Andrea? You good?
No, that's pretty accurate. On sub twos, we get requests. A lot of times they add the solar in, to the purchase price or the water softener, whatever the UCC lien is, which just kind of muddies the transaction, because then they want it shown on the settlement statement and everything like that. So we prefer to just kind of bypass the UCCs altogether and have it moved to exceptions.
Yep, I agree. And Wesley, you got your hand up again, or is that old? I'll let him respond here in a moment if you'd like.
Yeah, that's old, Scott. Sorry about that.
No problem, buddy. So let's see, Alex had another question here, or Kim did. So can you do a subject to with cooperation buildings? Sure, you can sub to anything, whether it's residential property or commercial property along the way. So long as there's a mortgage lien on it, you can take it subject to that mortgage lien out there. I will point out one thing I think everybody needs to be aware of, that you know, there's a prevailing school of thought that with FHA, VA, and home equity loans, you cannot get title insurance for that. We have been very fortunate, at least through Stewart Title, where we can get title insurance from them, that we are allowed to issue title insurance on a sub-2 or a wrap where the underlying debt is a FHA or VA type loan.
But that comes with your disclosures, correct? That is a
Yeah,
Horne
they want to see our
Associates.
disclosure package included in that transaction for that purpose, just because they like it. It's ensuring for this full disclosure of everything. And where that comes from, guys, is there was one lawsuit filed back in like 1990 about an FHA loan that was done this way back then. And there hadn't been anything since that point in time. And you're going, really? And so today they are, you know, moving forward, allowing that to happen with FHAs and VAs out there. But they do want to see the right disclosures out there, that the parties have full disclosure of the transaction along the way. Let's see, last question here was, so if it's a UCC, you cannot take a UCC lien sub-2. You either don't qualify for it with the lender or not. That's the only way of doing it. And again, if you're going to get want it released, it's going to be that UCC3 to be filed of record, both in deed records as well as Secretary of State's office to remove it, and then roll from there. So as we wrap this up, guys, oh my gosh, it's 1 o'clock already. Any other last questions from anybody?
Yes, me.
Me too.
Uh-oh. Go.
Okay, I go
Hey.
first. 2 questions. After closing, if the seller also finance or second lien on that wrap, subject to wrap, after done paying, how to lift that one? You submit in yourself, or you have to go through a title to really lift that lien with the certified loan letter from the seller?
No, you know, any party can, the note holder, whoever holds that note that's been paid off, is supposed to execute a release of lien and record it today. And so if it's against you as the investor or the owner of the property, you want to make certain that you get that document, know what it is, obtain it, and ensure that it gets recorded in deed records.
Okay, how to obtain that one right there after we paid off and get the letter from the satisfaction letter from the lender, which is the seller, that payment. So that letter right there will be sufficient to file in as to really.
Well, no, it's not going to be a letter. It's actually going to be a document that's going to be recorded, signed and notarized, called release of lien, recorded into deed records.
Okay. Second thing, for subject to, when we have the document there, do we need, let's say after 30 years, it pay all off, done with, do we still need some kind of release of any responsibility from the seller to the buyer, from the original seller, to say that yes, even though you pay off the mortgage now, it's still, or the SCR out, whatever which one to go.
Well,
do you still need to
you
pay
would think you would not need it, but most title agents are going to want that to be released as well.
Okay, so that release one, it pre-signed with the seller at that point closing, or we have to chase after some years down the road?
Well, and hopefully you've got the power of attorney for that seller that you're able to utilize to execute as needed appropriately.
Sounds good. Thank you so much.
Who else?
My question is, do you guys do ROPS or any services for the Georgia residents and properties in Georgia?
Well, we do the real estate closings in Georgia,
Okay.
buying, selling. We do loan processing, underwriting in Georgia, and loan servicing as well.
And all that can be found on your website?
It can.
Okay,
Go to theownerfinancenetwork.com
I'm there.
and find it all. You can probably go to First Option Title and Horne and Associates PC and find that as well.
Yeah, I see that. Thank you so much. Appreciate it.
You're welcome. So guys, we really appreciate you all taking the time to be on here. The whole goal of this again was to help you all be better, understand some of the things that we see along the way and how we get these deals done quicker and faster for everybody. Because again, that's what we're all here to do, is get these deals closed, have a better understanding. And we're here to help you all out, whether you're in Texas, Arizona, or nationally. Take the time and reach out to us. You can find Andrea's and Monteil's contact info as well as ours here is in Dallas on the websites on the Owner Finance, theownerfinancenetwork.com. And we will look greatly forward to helping you guys with anything you got. Randall, great questions today, or answers, my friend. Thank you for the help. It's always nice to have a good expert involved. And we hope to see you guys next time around when we do this for everybody. Have a great day. And I want to hear everybody go whoop for the Aggies. Okay, come on.
Thank you. Thank you.
No. Bye, everybody. Thank you all so much.
Have a great weekend.
Have a
Thank
good
you.
weekend.
Y'all too.